because we also, many of you may know, we also offer this via webinar. So we have people live listening as well, and I don't want to keep them waiting. So I'm going to do a quick set of introductions. Okay, we've got about 2 or 3 minutes. I'm going to do some quick introductions, and then we'll let Joe and Melissa get started. But I see some new faces, so welcome if you haven't been here before. Really quickly, this is Thursday's Insights. So through the Southern California Institute, we offer different types of programming. So this is the home page of our institute, our educational platform, okay? And through our educational platform, we do client types of events. So that's family and business owner events. And that's where generally we're partnering with other professionals to do events for clients. That could be current clients, so stewardship type of stuff, or it could be prospective clients where we're trying to get new business. But we do a lot of that. We have advisor and provider education. That's where we grew up. That's what SCI is kind of known for, doing education for other professionals. So advisors, teaching advisors. Multiple disciplinary, all different types of professionals coming together to learn from each other. We started out with Thursday's Insights. You can do this too in your community. You could have an event in your office every week. So we talk about those kinds of things. And how do you become, has anybody heard of a salt lick? You guys know what salt lick is? What's a salt lick? Kevin?
In the woods for deer to lick for thirst.
You want everybody to come to your house, right? So that's kind of what we've created here. We've got a thought leader community where we've got everybody coming together to create a whole set of resources for you to draw on and meet new people. So we do a lot of this type of education. We also do some conferences, 2 or 3 conferences each year. We have tailored programming where we're working with groups of advisors on a series of topics, maybe an estate planning series, maybe a business planning, maybe real estate, or maybe a combination thereof. So lots of tailored institutional type programs. And then that's also where we offer our laureate program, which is a higher net worth program on advanced strategies. So if you're into that kind of thing and learning charitable strategies or exit planning, like Melissa and Joe are going to talk about today, laureate program might be a good place for you. And then we take all of our live programs that we do here every week and we turn it into a product and we put it on our virtual learning center. So you can go to the SCI website, scinstitute.org, and you can check out all the different programs that are available via recording, and there's an audio of the recording and then a slideshow that goes with it. This recording is available for free for a week after today. So if you'd like to go and obtain it, you just go to the website. You can always send me an email if you can't find it. And then after a week, it's $25. But you can always send us an email. We'll send it to you. We're not doing that to make money, obviously, right? So that's SCI. And then some of you have seen this. This is the family of resources that we have here in our office. We have the Institute, which I just explained. We have 2 law firms. We have California Estate and Elder Law. And California Estate and Elder Law is that 99% of the world. That's your basic wills and trusts, your elder law, long-term care planning, estate settlement for after someone dies, your everyday estate planning. And then Straderi Mancini is the law firm that's working with that higher net worth client. So generally, those that have an estate tax issue, so about $20 million in assets or higher, have a complexity, they've got a mess. That's Joe's favorite client, right? Those entrepreneurs that come in, what do you call wild-ass entrepreneurs, right? That's a Straderi Mancini client. And then Founders Group, I'm gonna let Joe and Melissa tell you a little bit more about Founders Group, but that's the 4th piece to this puzzle, and we've got Founders Group working strictly with business owners and the business succession or transition of their business. And so that's our topic for today, right? So I will let them get started. Where'd she go? Oh, there's Melissa.
Did you get my tip, Melissa? You did.
Who gets to control?
Me.
Okay. What a surprise. Yeah.
Pardon all the technology.
Thanks, everybody. Yeah, we are actually, this is not something we normally do every day. This is Jason. Jason offers.
Everybody say hi, Jason.
An attorney CE, and so this.
Somebody
this
makes a joke
course,
he's kneeling in front of me. Playing with my belt.
And we just met.
Right? And this course is actually going to be offered on attorney CE online, so continuing education for attorneys member by the state. My goodness, today. You know that?
So, our normal basis, you record your different sites that you, I think you know. Well, you can just go that online at the same time. So, Stacy's over here, and she's online with people that will ask questions through Space or have questions about what's going on. So this is simulcast, we call it that. And also, like she said, they're recorded afterward. Very few of our programs, we record the faces of us up here. More often than not, it's this that is being recorded, the PowerPoint itself, what's on the computer, and our voices and your questions. So just know your questions can be recorded on there as well. So thank you all for coming. How many of you work with business owners in what you do today? Cool. How many of you own your own business? Okay. So how many of you are financial advisors by trade? You get paid for asset management or relationships? Okay. And how many of you are attorneys? Or what? Attorneys? What is that? Attorney. People like me. And then CPAs or accountants. And then what is this about? Those people that haven't raised their hands yet, what do you do?
I run a sponsorship acquisition.
Oh, sponsorship acquisition. Oh, I can't wait to hear what yourself.
I'm a connector and also.
Well, yes, sir. Say that one more time.
Business strategy.
Business strategy. For exit or for growth? For exit. Great. And do you work mostly in the ESOP area or mostly in which area? Over half of your clients end up implementing what kind of strategy?
It's not
And which is it?
mostly the outright capabilities in 3 to 5 years.
Okay. But they end up with a true sale. And is your compensation for the consulting period or a percentage of the sales price back in?
So,
I'm sorry, say again?
on Sunday.
Okay. Yes, sir.
I run a niche group for Southeast real estate firm. Jay Kennedy's with me. She's on my team.
Very cool. Anything else to add there? Yes, sir.
Small business consultant, helping them develop a plan for exit.
So long-term plan, yeah.
Yeah.
Do you include transition to family members as well?
Yes.
Very cool. That picture might be better from here, so you don't have that. Come on over.
But she wants a picture of that happening.
Oh, this? Great. There you go. But you want to Very cool. So thank you. Well, a little bit about me. I'm Joe Secretary. The Secretary is Secretary of State. That's South. My business partner, Steve Mancini, and I started this mess 28 years ago. And what you saw on that, those four entities started out as one law firm. Over time, what happened was we broke out our marketing, we broke out our base level planning, we kept our advanced planning, we broke out what we did for business owners. Does that make sense? Great. Now, the independent firms that run themselves, and I'm saying within the Southern California Institute, there are a couple of businesses inside of it as well, like our lawyer programs where we teach how to attract, engage, and work with $20+ million families with 2 programs. Our Certified Wealth Strategies Advisor program, which is a 5-day program, and our Lawyer Wealth Strategy program, which is another 5-day program. The first one is mostly on technical, the second one is mostly on how you counsel to that, all of it includes the marketing side, the case management side of that level of case, the technical side, and then the true counsel. So today we're going to talk about businesses. Melissa Silverman, let's go back. Melissa Silverman, one of my partners, is a valuation expert. How many people know what valuation experts are? They take a look at a large stacks of paper, they find people, they find all the problems, they determine a valuation. It should always be the same valuation, whether they're on the buyer side, the seller side, or the gifting side, but oddly enough, sometimes they enhance one area or another. Is that fair? we have been working with Alyssa and her companies for over 12 years. We had originally, because we had a higher end estate planning firm, use the services of her in the valuation side for guess what kind of work. Because we did well transfer work, gifting of fractional interest in things that we've loaned down in generation into trust other things, new rats, whatever that was, gifting, and for estate tax purposes. Somewhere along the way, we figured out that those valuations, when it came to assets, whether it was receivables, notes, businesses, whatever it was a report on all the problems that we could fix that would make it work more. Does that sound like business consulting? Yeah, it took us a while to figure that out. Why didn't you tell me to start with? General language didn't tell us. So, should I be frustrated or Melissa has a whole slew of designations, including a certified exit planning advisor and a variety of other things inside of that valuation stuff. I am a general contractor by trade. I hammer nails to go to law school. You might call me a trusted estate, a T&E attorney, or a tax attorney, asset protection business. I am a former litigator, completely recovered. I had a massive heart attack and 6 bypasses at 38, which helped me recover from litigation. It's still tempting. I still don't mind going in and doing the work. I don't mind court work. I don't mind the mediation work. But I do mind is all the stuff where people get angry and send lots of anger over me. That part of it. Within that, my partner Steve Mancini and I are very similar. He has a business background. He was an attorney, left after the Navy, left being an attorney to work family businesses like I did. Came back into the practice of law and we joined together. Created this, have partners, and at this point in our lives, work about 23 weeks a year, about 20 or 25 hours a week, because our partners run the firms and then do the balance out. Make sense? So today, it gives you a background on that. So we've got a bench, right? We've got a bench of valuations and tax attorney stuff. So by definition, by how we get paid, we grew up in the industry with kind of a way to think about it, right? Also, neither one of us are talking on the transaction at the back end, so we probably have more of a bent on keeping the business in the family than selling it. Though over time, we've had to evolve because our clients are now of an age that it might not make sense, like the couple we were on the phone today. I don't know how they are, but I'm willing to bet those in their 70s.
Kind of late
60s. Now, their energy level, higher or lower than it was 20 years ago. And there's somebody they've been doing business with, their supplier from another country, that's come in and said, we'd like to give you a big check for your distribution. Were they interested? Yes or no? Yes. They've had a company for over 30 years. They're wonderful people. What was their biggest concern? Employees. Say that again. Employees. Who's going to take care of their employees? So on that transition, we've got to be concerned about more than the big dollar amount. There's other things to look at. They had started because they thought about exiting, but they were going to stay for a while, and they were worried about their employees. So what kind of plan did they put in place 2 years ago? ESOP. What is it that they hate right now? Their ESOP. And how much do they understand about their ESOP? And the wife, who's now finding out things about the ESOP, is she angry or is she happy? Very angry.
No, she's actually frustrated.
They're willing to share. So on the board it says that we lead business owners through these transitions. We're big on the if, when, how much, and who. Remember our bet. Now, our typical client now, though, may not be able to keep the business for health reasons or energy reasons, and may or may not have another generation that's willing to take over. In your experience, Melissa, the people that created from nothing, like this couple, to this day, 30 years of being married to this business causing it, did the children value the business, or did they consider the business was a hindrance to the family?
The thing is, they totally don't want business.
Why not?
Because they're off doing their own thing.
But they built this. They wanted their kids to have it. That was their legacy.
Well, their children, in this instance, are their employees. It's not their actual children.
So in their instance, their family has become the employees. Often, when you become a business growth, you may have a generation that wants to take over, and occasionally the ones that want to take over have the talent to take over. But often they don't. Is that fair? And what do they do about that? So we have been looking more and more at this. If it's when we get to a sale, it's all or part, internal or external. So do they sell the entire thing, or do they sell part of the thing? And do they sell it or transition it to their family members, either by gift or by sale, whole or part, to their employees, whole or part, or to a third party? Now, what do most of their advisors want them to do? Why is it that they want them to sell? AUM. There is a lot of compensation that happens if the business sells. Valuation experts, attorneys, investment bankers, life insurance, assets under management experts. So lots of people are interested in the whole sale out to a third party, right? And is that appropriate sometimes? Is it appropriate every time? But there are all these other options. We're going to talk about how you filter through that today.
So when we're talking about exit planning and business transitions, we actually start by asking 4 questions. We start with, where are you now? Which we call the current state. So what does your current situation look like? What does the business look like right now? And what is your situation personally, the business owner's family, and what does their personal and financial situation look like? We have to get a baseline understanding of where the business and the business owner are at in the current state. Okay. Then we ask the question, where are you going? So that's all about, where does the business owner want the business to go long term, and where does the business see his family? What does he see on the horizon for the family? So we have to get an understanding both strategically as well as tactically. So that's where we're asking them questions about, where do you see the direction? And then from there, we're asking, how are you going to get there? And that's all about making improvements to help them be able to achieve the goals and objectives that they've identified as their long-term objectives. And then what's next is, what happens once you've made the improvements and you've exited from the business, what's that next phase of your life look like? And helping you to plan for it now, so that when you get there, you don't get to a point where, it's the day before the transaction's supposed to close and you don't know what you're going to do the day after, and you decide, I'm not going through with the transaction, because you didn't plan for it and you weren't already doing it, and so you backed out of the transaction. If you plan for it, then you have a much more likely chance of the event succeeding.
So we get asked often, why is it that clients work with you as opposed to others? We've known this family, Barry might say this, I've known these people 9 years. They're doing something now. Why is that? There's a variety of them. One, we tend to do a lot of intake. We care to know the last 10% of their data. So they feel, and they're correct, that we understand them better than somebody else did. And next, we're able to set out a clear path in English as to what's going to happen. Those of you in this business know what these things translate into in business terms, in our own technology terms, in our own technical terms. But our clients don't understand that. So the clients that were on the phone today entered the phone call incredibly frustrated. We did not fix their problem today. Is that fair?
No, we did not.
Did not fix their problem.
They're still frustrated.
But
they feel better about who they're talking to, because we didn't give them solutions.
They didn't get solutions, but they feel better now. They actually said, no, thank you so much. I feel so much better. But we didn't give them any solutions yet. But they now understand that there's a pattern, there's a way in which to get from here to there. Here are the steps, here are the variables, let's figure this out. And they, at the end of the call, heard, this is no more, no less than a business decision. You just don't have data points. Here are the points you're looking for to make that choice. And she said, yes. And she said it very, very politically correct. She danced around. I asked her if I could translate afterwards. I said, so what you're saying, because she was very politically correct first. I said, what you're saying is, you aren't getting the correct data or the information to make a good choice. And the choices you've made have turned out wrong, and you don't want to do that again. Yes. So that's what you're going to hear from this.
Just before you go on, to what Joe is saying, the advisors that they have worked with in the past have, and this happens frequently with ESOPs, they lead you down one path, one very narrow path, as opposed to exploring everything. And that's why these business owners are very frustrated. Whereas we take a very different approach. We take the approach of, we don't know what's the right outcome for you until we explore everything with you and understand, get to that 100% where we actually, that last 10%, we really understand what your situation is and what you want to do with your family and your goals and your objectives. That's when we can really identify what is that right solution for you and your particular situation.
So for all the professions that we talked about in the beginning, the difference is going to be, and this is from our laureate program, the difference is going to be whether the advisors in the room were invested in a solution that they needed to drive to, or were they involved with the client. Now, I would tell you, if you're involved with the client, there'll be tons of solutions. It might not be the one you decided before you met them. But if my cardiologist decided the procedure he's going to do next on me before he sees me, it scares me. And he's got a good idea about me, too. Now, remember, everybody, I was the one that had the massive heart attack and 6 bypasses at 38. So you can kind of predict that some things are coming in my future. Is that fair? But I'd prefer he not guess them before I walk in the room. I'd like him to do some data points. So this, if you notice, the questions are the same. What you see to the right of them, current state, future vision, enhancement initiatives, and business transition, are the technical terms of what we're doing. And you can see what those steps are involved. Melissa talked about doing the valuation, which we'll talk about the assessments. And then the way in which you do tactical planning. How many of you sit across from a client and counsel them through their issues? Help them understand their options and counsel them through. That's what that is. Whether you're doing it with a business owner and their executive team, the owner and their team, or the owner and their family, or all of it, in order to come up with now the plan. So would it be nice to know what they've got, and then come up with a plan of what their options are, and then decide what to make better? We do them in 90-day sprints. We call them 90-day sprints and do them that way because entrepreneurs' patience is about this long. They're very willing to work on something for 90 days, but that's about the limit. Now, if my son, the 16-year-old, owned the company, would he wait 90 days? He's got about a week, right? He can think 1 week ahead.
And you're different because...
I go through entrepreneurial seizures and I have people around me that help. That was Shelley's voice, everybody poking at me.
Joe has a thought and he thinks it's done.
Well, all of you help me. If I conceive of an idea and we do the research on it, and we lay out all the particulars and we get our collaborative partners to say yes, and then we're now down to the details. Is it done in my head?
Yes.
I have an amazing implementation team that doesn't know from no. It's over, under, around, or through is how they get to it. Through being the hardest, but if you make us, we'll do it. So if they've never failed getting it done, is it done in my head? Is that okay?
Mm-mm.
It's terrible. I have the mic. Huh?
Shelley, I'm with you. I'm
We were on a phone
with
call
you.
today where Shelley was.
Experienced it a little
Yes.
We were on a phone call today when Shelley was trying to explain to me, but that is going to take a lot of effort. At the end of the day, this is where everybody starts. In fact, the call that we had today, the lady said, "I've read your brochure. We're at stage 4. We're in the transition." Mm-hmm. And Melissa took a breath and said, "Yes, you're at a decision whether you're going to keep and grow or transition. But oddly, if you want to transition, you need to do this.
You gotta start over.
You need to do this unless you're willing to take less money. You need to do this unless you're willing to take less money." Upon which she said, she's willing to take less money. Doesn't everybody turn around funny with that? They're so fed up, they want it over with.
Yep. Yep.
We're going to get less money, that's okay. As long as we take care of, Kevin,
Employees.
our employees. Well, if this is what it takes to take care of the employees, okay, we'll pay you for that.
Sorry.
Would our counseling for that client be different if we didn't know that data? Very much.
Really?
Getting adjusted.
Okay, so while she adjusts,
Recover for a second.
I can't do
business
this.
valuations, attractiveness,
We're gonna hold
readiness.
No, I'll do it. Sorry. Sorry, everyone. I was not told that this
She
was
wasn't-
happening.
She wasn't actually dressing back there. She was just.
So when it comes to the valuation and the when we start this with the current state, it starts with evaluation. It's a comprehensive valuation that's done by professionals who have the proper designations to do qualified valuations. These are not, back of the piece of paper. Let's just do some recasting of the financials and let's look at some rules of thumb and let's come up with a quick and dirty value for the company. That's what a lot of people and a lot of business owners, that's what they want. That's not what this is. This is a comprehensive valuation where we're really doing an analysis of the business and looking at the strengths and weaknesses to come up with a baseline value for the business. But in addition to that, we're also doing these assessments where we're looking at the attractiveness of the business as a potential buyer would look at it. We're also looking at how ready is the business right now in its current state for a transition. But not only are we looking at the business, we're also looking at the business owner and looking at how ready is the business owner both personally as well as financially for the transition. Because that's going to be what allows him to get over and sign those documents for a transaction to occur.
So if I went back on the slides for a second, which would work, a client who's a business owner doesn't come in saying this. But if you listen carefully, you're going to hear some of this. They're looking for increased clarity. The clients we were on the phone with didn't get a solution, but they got clarity on their problem and then a pattern or a timeline or a process to a solution. But they got clarity. And they felt better on the call because of the clarity. They want an increased net cash flow. Most business owners, are they building for value or are they building for lifestyle?
Income.
They're building for income. They are rating their business on how much it gives them every year. Is that business worth more or less than somebody building for value?
It's worth less.
And that irritates business owners because they say it's EBITDA times this multiple. As long as my net is more to me, it's worth more. And then Melissa says no, and they say, why didn't anybody ever tell me that? And they say it can't be true. But they've rated, if they got more cash flow, it'd be good for them. Then market value. They know that there's a secret to getting more for the business. They've heard about a strategic buyer versus a
financial buyer.
They've heard about these things, and they hear it. It will increase that what? That multiple?
EBITDA and multiple.
EBITDA. What's EBITDA again?
Earnings before interest, taxes, depreciation, and amortization.
That just means it's more than I got this year. And it expands and solidifies their choices. They want to understand. They know there's more choices. They just don't know what they are. And then they want to choose from them. This is a fancy way to say what they're looking for. It's at this point, when Melissa's doing the valuation, that she's able to talk about all these things.
And the valuation doesn't just look at the current value. We're also looking at what's the growth path and the projected value that the business can get to within the current realm of where the business is valued today. So we look at that as well. So when we're looking at the attractiveness, we've talked about some of the stuff. We're looking at if the company is not ready for a transition, then the value of it is going to be eroded. So we're looking for what of the things that we can do to mitigate against that. So we want to look at the risk. What contingency planning has the company and the business owner done? What is the company completely dependent on the owner, or does it have a really strong management team in place? Has the company had insurance reviews? Does the company have a buy-sell agreement in place if there are multiple owners in the company? What does the profits of the company look like, or is it negative? Do they even know what the profitability of the company is? Are they tracking on it? A lot of times companies aren't even looking at and tracking on their financials? Do they have audited financials in place? Or are they just, being done on an annual basis? A lot of times companies aren't even, they have a CPA that will do it once a year. That's not enough in this instance.
So let's talk about a company. Let's say there's a company out there and they say, we're very proud. We have built this, my wife and I have built this over 30 years. I tried to back out about 4 years ago. I'm proud to say that in my 60s I was able to come back. I'm working 60 hours a week and very proud of it. We almost went under, but we're fine. I have some great relationships with people that were able to say, yes, we still believe in you. And over time, I've been able to grow my biggest account to be over a third of our business, and it's been good for us.
That's a problem.
We have a lot of stability.
That's a problem.
My son-in-law has been in the business. He's about ready to take over, he thinks, but he really doesn't understand. And my daughter has become the accountant. I know there's a few problems, but I can tell where they are. Are there any risks in that business?
Yes.
What are the risks?
The fact that a third of their profit comes from one client.
Or a third of the business from one client?
So
Why is that a risk? That's a good thing. I can count on John.
If once you're not there, it's your relationship, so they're probably going somewhere else.
Oh, that's another risk. What was that risk?
The risk of that it's your relationships, your clients are going to go elsewhere.
Is if I'm working 60 hours a week, is the business somewhat dependent upon me? Is that a good thing or a bad thing? Well, it's a good thing for my ego. It's a bad thing for the value. What other problems did you hear in there?
Accounting irregularities.
Accounting irregularities. Do you get a higher price or lower price when you constantly have to do adjustments during the sale? If you have adjustments, all that is giving the ability for the people on the buyer side the ability to lower the price. What else did you hear?
Competence of the leader, of the son.
Competence of a son, or son-in-law in this case, right?
The succession plan, right?
There's a little bit of family dynamic, and I just said he thinks he's ready, but is not. You're starting to hear pieces, right? Now let's do another business.
Wait a minute. There's also the daughter is a CPA. And so there's no objectivity and independence with the financials that are being reviewed.
You mean I have control over my daughter? My daughter's 12.
Still your business.
So let's do another business. How would you construct the other business to say it was worth more? I work 35 hours a month or a week? A week. What are you going to say about my accounting firm? Independent third-party firm. What else are you going to say about my management team?
I can be gone for a month at a time without any concern.
I can be gone for a month at a time without any concern. What can I say about my son-in-law and my daughter? I engaged a firm to help train them. We have an executive team in place that's alongside of them. What can I say about my client base?
Diverse.
We made an effort to, we saw a third into one area. We've since diversified our client base. We increased our volume enough to where that third is only 15%.
Is it better if you've never met them?
Never met the clients? So they're less dependent upon our relationship. They're more dependent upon a relationship with the firm than the star.
And what about systems and processes? You need to have some in place. They need to be documented.
We hired a firm that actually computerized our systems and processes. It's proprietary to us. We have other people in the industry that would like to have it. Which firm is worth more?
Second.
So you're starting to see how evaluation points out things that you can work on to make it worth more. And there's other stuff too.
There's many other things. But then we get into the assessments. And these are a series of questions that are going to really relate to how attractive does this business look to a third party. Because, if it doesn't appear attractive, then they're not even going to come to the table. But if your business does appear attractive, now you've got somebody who wants to sit down and talk with you. But then the next hurdle that you have to overcome is your business ready? So, and that's where they're going to really go through and scrutinize every aspect of that business. So if it is not ready in all areas, they're going to uncover it and they're going to start shaving down the price of the business if they even go forward with it.
So there's a difference between dating, engagement, and marriage. If marriage is the goal, the attractiveness during the dating part has to be there, right? And if you want to marry a particular kind of buyer, you have to decide how you're dressing up for that attractiveness for the dating. Is that fair? It's the same thing for businesses. It's going to depend. Remember that step where we said you did that counseling part with the executive team or the counseling part with the family? You're really deciding what it is you want at the end and then dressing up for that. Because you'll structure it differently. The accounting firm that we're meeting with, the temporary accounting group that we're meeting with across the way, their biggest focus is cleaning up the financials because that's what they're really good at. Is it important to clean up your financials before a sale? Why? Because if you have me on the other side as a buyer attorney, if you have messy financials, I tell them, go enter the deal. While we're in it, I'll get the price down. They give me all sorts of ammunition. Sign.
They want to see, buyers want to see that you are not running personal expenses through the business. And if you are, you need to clean it up before you, in the planning process, before you go and transition that business.
Every one of my entrepreneurs runs their personal stuff through their business. We call it business expense, and it's business entertainment. It's largely travel. It's entertainment. It's
vehicles.
It's all those things. I've watched deals go south because the company car was being taken away.
I've seen nanny expenses. I've seen airplanes. I've seen everything in these adjustments.
And we didn't show her our books.
Where's mine?
Jackson
I don't
Hole
even
flight-
have a helicopter yet.
Private planes to Jackson Hole is only because to make sure we get in for the fishing and get out on time.
Mm-hmm. But all of this, what we're doing...
This is in honor of Jeff, our other partner.
Yeah. So, but everything that we're doing here is to try and build value. We're trying to increase the enterprise value of the business. And we do that by increasing two things. We increase the EBITDA in the business, and we also focus on increasing the multiple. And when you do that, what you're going to do is the example there, if you start with $2 million in EBITDA, you increase it by $1 million. So now you have $3 million in EBITDA. But you go from a multiple of 4 times EBITDA to a multiple of 6 times EBITDA. You've gone from an $8 million business to an $18 million business. That's what we're trying to focus on here.
Now, that's a pretty extreme example. It's one that's real. It's extreme. Here's the issue, though. Business owner considers selling. This business owner here that had an EBITDA of $2 million, how much were they getting in salary? How much were they pulling out each year about? Because that's a recasted thing.
Yeah, they were probably pulling out $500,000 to $1 million.
So let's say they're pulling out $1 million a year. Somebody said you can sell your business for that. Now, if they sell the business for that and they start it themselves, are they going to get that much to go to their advisor to manage? No? What are they going to get? Why is it going to be less?
You're going to have to adjust for the excess salary.
Well, that's true, but let's say we got this number under this math. Taxes. Well, there's those fees that we all take. There's the $500,000 or better in costs of making that sale happen, right? Maybe a little bit more than that. And then there's taxes. What percentage of that goes away in taxes, federal and California? What kind of taxes are going to be paid?
Cap gains.
Cap gains, as long as they had it more than a year, they had it 30 years, so capital gains. Long-term or short-term? Long-term capital gains, unless they transferred part of this to their children's trust 6 months ago, then the children's trust gets to pay short-term capital gains. So it's wonderful when you're in the room and you can explain that to the parent, that the kids' trust is paying more because they didn't know that the transfer was going to cause a short-term capital gain. Well, let's assume they did it right. It was long-term. So $8 million. Long-term capital gains plus the state of California is a total what percentage at the end of the day today? Between the federal and the state. The federal is how much?
20.
How much?
39.
So let's say 37. Let's say about a third. A third of that number is about $2.5 million bucks. Plus the other $500,000 that I said in expenses is 3. 8 became 5. Who in here manages money? Okay, somebody tell me with $5 million to manage, how much am I going to get every year as cash flow? If I give you 5 and I want income to live on the rest of my life, how much do I get? Okay, so let me understand this again. Melissa, help me. I was getting $1 million a year out of the business, And now I'm going to sell it into the rest, and I'm going to get how much a year? 250. Is that about right? 5%? Because you let it sit in there and keep up with inflation and all that stuff? Could I get more than that? I mean, you're looking over. Should I be getting more than that?
How old are you?
I'm 54 today.
You're getting 200 a year.
I'm getting 200 a year. If I was 70 today, how much would you allow me to get? 400 a year. Because he wants my bucket to not run out. So I owe those, even if you took the 400. $1 million versus 400, that sucks.
It's big.
Right? Business owner says, let me understand this again. I'm pulling $1 million a year out. You're going to give me 5. It's only going to produce 2. How about I keep it for 5 years? I get 5 out and I still have the asset. That is what happens to almost every deal. That's the business owner and what they go through. So Melissa says, okay, that's true. How about if I do this for you? I'm going to do this stuff, and instead of 18, let's just assume I got it to 12. Let's assume we increased EBITDA, and we increased the multiple, and we got it to 12 from 8. Out of the 12, I'm going to lose about $500,000 again. The taxes, about a third, is about $4 million. So I've got 7.5. 7.5 is going to generate me how much?
254.
I'm up to 400. It's feeling better. If I was 70, it generates me how much? 6. But I lose the sway of the business making and losing money. I lose getting another heart attack.
Right, it's worth it.
Is it starting to become sexier to me? If she can make the 18 number happen over 4 years, 18 minus the $500,000, or let's say $1 million for that sale, the taxes on the 18, let's say about a third, 6. 6 plus 1 is 7. I get 11 net. How much do I get out of 11 a year?
Quite a bit. Yeah.
Unless you do some planning ahead of time, such as estate planning,
You mean I
tax
could
planning,
do tax planning and
financial planning.
so if I'm only worried about me, I could actually put it in vehicles and not pay the capital gains tax and get all 18 to pay on. How much do I get off of 18? So
Do they get a million?
Just about. I know.
So now I'm starting here. If I work with Melissa, the math of this changes. Now, some of that planning, I would have to irrevocably lose control over the money, so not to some, but all. And then the owner says something like, get me to $700 a year of income, secured over time, get me this much to access in cash, can you do that? And gentlemen like the one over in the corner says, yeah, I can do that.
So
And he says, I've got a team, and he brings 6 people into the room who can do that. Is that fair? 4 people.
Charlie Kraft over there. How do you increase the multiple? That was my question.
So
And
Joe,
what is a multiple?
So what is a multiple? Is just it's a multiple of your EBITDA. So it could be 4 times your EBITDA number. It could be 2 times your
Come
EBITDA.
up with multiples?
So a
That's what
multiple-
I'm trying to get at is
So an industry has a variable, right? So let's say I'm a general contractor by trade, right? Let me say construction. Construction that has about a $10 million annual, a $10 million worth that is doing the kind of numbers that would generate that. What kind of bandwidth of a multiple for a construction company?
I don't want to go where you're going. So all industries.
If there's a bandwidth of an industry,
I'm going to be really careful here. All industries have a range of multiples that are standard. They're just considered to be standard multiples for that particular industry. Rules of thumb, you'll hear often, construction might be 3 to 5. A lot of industries it's 3 to 5. If you're looking at technology or healthcare, you could be in the 7 to 12 times multiples.
It
really
people are willing to pay
It
for
really depends upon the industry, but we actually don't go there. We actually do an analysis of the business because you have to look at the business and you have to see what's going on in the business. What kind of debt does the company have? What kind of concentration issues do they have? What kind of management issues are there? We have to do an analysis of the business in totality. We can't just look at rules of thumb which apply to industries and say that that is what is going to apply to this particular business, which is why I didn't want to completely answer that.
So those firms that are in the business that don't want to do a valuation but want to work with the client, recast financials, they say the bandwidth is from here to here, They do an assessment and ask the owner, do you suck more or less than everybody else? And the fact that you suck more, you're on the lower end. The fact that you're more, it's here. We'll weight it. We come up with a multiple, and we say you're worth that. If we fix those things, you'll be worth more. Let's do it. As opposed to a true valuation that points out the what's that you then work on and benchmark, which is what we believe in. You're still helping somebody help it be worth more. The question is, are you doing so in a way that a bank will analyze in order to lend somebody money to buy the business? Fair enough? Now,
and our valuations are reviewed by banks all the time because the buyers oftentimes need to have valuations done.
Now, the strategic buyer that we were talking about earlier, that was the supplier for this one company, they were trying to buy a distribution channel. So they're going to use a rule of thumb and get a valuation, but they might pay more because they need this distribution channel. The more that they hear the couple is feeling less energy, the less they'll pay for it. They want to pay the least they have to, but they want the employees who have the contacts and they need the distribution channel to make that work. So hopefully that strategic buyer would pay more. You had a question, sir.
Specifically in some of the higher ticket ones, such as Facebook's buy of Oculus Rift or any of the ones that had a ridiculous multiplier out of nowhere. One of the reasons that they were cited as saying was because of either market control or influence. It might have already been answered with your distribution channel comment. Does the control over a market affect, where does that affect? Does it affect more on the multiplier side or the value side? And same thing about like influence, such as...
The value is going to be, this EBITDA is this strict number that she talked about. Right. They're going to say it was on the multiple side, but it's on the willingness to tolerance of what they're willing to pay. Yeah. They're going to call it the multiple, but it's what they're willing to pay.
Yeah, so you can find a buyer out there who's willing to do a lot of different things.
Last night at the Barolo tasting that I was at over in Ateca, I was sitting next to a guy who had a company in Boston, a bunch of technicians that created the ability to do soundtrack stuff, and they were doing a lot of work with Disney. There were a group of Motorola executives that were leaving that had a similar technology that were competing. They said, rather than competing with each other, let's merge together, offer both technologies, we'll win. Right? So they did that merger because they wanted to make sure that they both got to win. Inevitably, they didn't like the people. The two groups of people didn't like each other, and one was being used more than the other, so they got them out. How much were they willing to pay the people to leave? Apparently a lot. Now, the company's worth more because they've got their culture back to doing stuff. But that was more along the lines of a strategic buyer or a strategic seller going down its path.
And that's what you're referring to there as well. Oh, me?
Please.
Okay, so we've talked about the assessments on the business side. On the personal and financial side, it's the same thing. We have to look at the business owner and the family and say, how ready are you for this transition? So we're gonna look at things like your contingency plans or lack of. How much risk is there? What happens if the business owner were to die tomorrow? How much value is lost in the business? What does the family do? Is there a plan for what happens next? Is there any, do the business owners and the family, do they understand what they need to walk away with in net proceeds? We were talking about the transaction costs and the taxes. Do they really understand what they need to walk away with? That's part of that financial readiness. Have they had any financial planning done to understand what they need in the way of proceeds to be secure for the rest of their lives, for themselves and their families?
How many, for those of you that work with entrepreneurs, how many have a financial advisor that they sit down with 1 to 4 times a year to talk about their finances? What percentage would you say?
Sorry.
What percentage would you say? Entrepreneurs that have a financial advisor, well, they talk about how the cash runs.
It should be a lot higher. It's not enough.
It's fairly low because, remember, they've got their business giving them cash flow. They're done. So imagine, and this has probably happened to us 40 or 50 times. We're sitting with a couple. They're considering the sale of something. And they're talking about the gross and they're talking about the net. And one of the spouses has written down, because we keep on asking them how much they spend, and did they have an idea how much they spend? Absolutely not. They say, well, that was an aberration last year, and that was an aberration this year. And we don't usually spend that, and the child doesn't need this. But over the last 6 years, how much have you spent? Well, the number's oddly around the same number. And they look to each other and they say, my God, this big, really? Because we've got all their stuff. And so we're talking about the sale. And just for numbers' sake, they figured out that they're going to sell something in the high 30s and they're going to get $20 million net left. They've got to pay off 3 homes. They've got some money in investments that have not done well because the husband has tried to invest it and he's like me. I tell clients all the time, I have proven 3 times how bad I am at investing money. I don't do it anymore. The goal is that the pile's bigger. I'm an expert at making the pile smaller. Now, I could tell you in the middle it was bigger at sometimes, but like the guy that goes to Vegas that always wins, I got to tell you the pile was smaller. I don't do that anymore. I pay somebody, and after paying them, my pile's still bigger. So it only took me 3 times to figure that out. The wife in this case figured out that they had an $850,000 a year burn rate. And she, on her piece of paper, took $20 million and divided it by 850,000 in long division. I handed her a calculator because she was getting very frustrated. And she came up with a number. And she said, he can't sell the business. I'm going to live longer than that. What did she miss in her math? Time value of money. She took the dollar amount and said, it's a piggy bank. I'm going to take the bottom out of the piggy bank and shake out that much every year, plug the piggy bank back up, and then I'm going to have this left. And how many years will it run? And she actually changed the number from 850 to 700 to see how long the run would. And she said, I'm still living longer than that number. Because they never worked with a financial advisor to see that money makes money, because they'd never done that. They had been spending everything they made except for paying off the real estate.
The same thing is true with trust and estates and tax planning. Yesterday we did a webinar where we were talking about charitable planning. And there's a lot of things that you can do, and this is Joe's area, but there's a lot of things that you can do if you plan for it, from the way of protecting your assets against taxes. But you have to plan for it, and you have to do it ahead of time.
The first code is 145. The first code is 145.
How far ahead of time? A year? I mean, that long?
Well, this is kind of like we talk to clients about income tax planning. The person that comes to their accountant with a bag of stuff in February or March, or the person that comes to their accountant in the prior year in August, September, which person pays more income taxes? The one that brings it in and says, how much do I pay? The one that plans pays less. That same analogy works for business ownership and then the possible sale or not. The sooner you get on with this conversation, the bigger the multiple. You get the right kind of clients, all of the rest of what we're talking about, and you're not feeling pressured. You get used to the idea, you meet with financial advisors, you talk about reducing the tax and what are the structures. Some of this I'm going to put into place. I can't get to principal, but I'm going to get income. Some I'm going to put where I can get to. Some I'm going to give to a charity eventually. And you start to move all the levers a little bit, and they start to get comfortable. And in some people's cases, it takes years. How long did this couple own the business? Do you think they're going to decide to sell it in 6 months? This is a painful process. Absent one of the 4 Ds, death, disability, distress, and the other D. Divorce.
I thought you said that.
We talk with clients all the time about their children, about their children's future departing spouse. So on that second step, this is that part that you're all good at. When we partner with others that counsel, so when we partner with a life coach or with a financial advisor or with their CPA or with their attorney, often that person has a great personal relationship, and this kind of future vision is what they're used to doing. We just want to do it together. We're happy to help. We're happy to help split some of the money for doing that because we're doing the same work. And it's a matter of what do you want it to be. It's where you take the little devil on their shoulder that says, you aren't allowed to have this. You aren't allowed to work half-time. Your value is that you work 60 hours a week. One of my good friends, Jeff, who has a law firm just about an hour north of here, is in his 80s now. And somewhere along the way, he got told that if he worked less than 70 hours a week, he wasn't worth anything. And his health has declined, and he said, but I'm still valuable to my family. If I sat down and talked to his wife, would she want him to work 70 hours a week?
No.
Would she say that he wasn't valuable? But that's a conversation. Most of you are in the place to cause that conversation and bring it up and let them talk. Is that fair? This is where stuff like that comes up. It's where you find out that some of the executives may not want to stay if it's sold. Or have said, I've been here for 30 years with you. Yeah, I'd like something for that. Either a part of the sale price or to be able to be included afterwards for control. It's where you get to this last 10% that we talk about. Now, some people would say the value is in the restructure and the mechanics. Others would say if the deal doesn't happen, the value is in the interpersonal that's happening. We don't care where you sit as long as you recognize there's a thing happening. There's a thing happening that drives or doesn't drive it. The people that concentrate on this thing close more than 50% of their deals. The people that don't close 1 out of every 12. You choose.
I think one of the important things there is that last bullet is by going through this process, the tactical and strategic planning, that's where the things get identified that you're going to work on in the business. You've got to go through this process in order to identify what the issues are and have everyone agree that the not only the owner but the leadership team and the family.
By the way, when we talk about the enhancement initiatives, how long do we think an enhancement initiative should take?
90 days.
90 days. Why?
That's
it's an attention span issue. So if you have an enhancement initiative that would take a year, you break it into 90-day chunks. So that way there's a progress seen as you're going through it.
So for us, when we work with business owners, we split it up into strategic planning, which we do with the family first, because we need to understand what the long-term goals and objectives of the family are. And then we'll meet with the management team, and we'll also do strategic planning with them. Understand where do they see the business going? In what time frame do they want to transition the business? And once we have that, then we can do tactical planning with the management team and the rest of the team. And that's where we're really identifying and solidifying what those 3 to 5 initiatives in the business that we should be working on in the enhancement initiatives are.
So difference between strategic and tactical. Strategic is long-term. Tactical is in the next year.
And so I was sitting with a banker, and he said, Joe, what 5 enhancement initiatives could somebody come up with personally? I sit with someone like Charlie, and he says, what 25 personal enhancement initiatives could I have the client work on to get to there? I'll give you the top 5 off the top of my head. Fair enough? So this is, again, industry perspectives, right? 90-day sprints. It's about having, and now one of them is always going to be the financials, right? Very seldom will the financials not be an issue.
Correct.
Because it was built for cash flow, not for value. So keeping track of that, starting to remove personal expenses, starting to make it appear that it is a standalone company that somebody would pay for without adjustments. So let's get a year or 2 of that out of the run. So when you talk about waiting at least a year, 5, no, probably not longer than 5. One thing that we'll tell you, though, is most business owners that get to us that do this start generating a lot more cash than they used to. So they're ending up putting $1 million more away every year than they were. And they start to say, well, maybe I'll keep it for a little bit longer and make it run, which their advisor is fine with because they're starting to bake in more. And then eventually there's going to be something like, because when the business gets worth enough, most people that are concerned about their team and their employees and their family probably cash out for half and then include these other people in the other half over time. If it pays or not, that's fine. So all the advisors are now involved.
When we're looking at the 90-day sprints, what we're trying to do is we're trying to identify what are the most important initiatives that we should be focused on. So we want to focus on things that are going to de-risk the business first. So things of legal issues, insurance issues, any risk mitigation things that we can focus on first. That's where we want to start. And then we want to move to other things like looking at the management team, making sure that there is a strong management team in place. Or if there's not, making sure that we are putting a mentoring program in place. Because in some instances, you may want to elevate your managers because they may be the transition for the business. And if that's the case, then we do need to put that mentoring program in place. Looking at the products and services and making sure that there's systems around it, there's processes around it, that they are the right services and products to be offering to the market. Making sure that you're in the right markets. Maybe there are other markets that are more of growth markets. Making sure that you're not stagnant. We have to look at all of these things and take a look and see where are the improvements that need to be made.
Have you started to hear in that tone? Remember the first conversations, the tale of two companies, where we said this one was worth less, that was worth more? Are you starting to hear similar themes, right? Of course it's going to be driven by the valuation, what you're looking at, to make it worth more or not, and which kind of buyer. But also, are you starting to hear the things that prep you for sale for a greater value are the things that make you more stable for a better cash flow? Are you starting to hear that? So it starts to make sense to a seller, because sellers don't do this every day. There are some serial entrepreneurs who build and sell, build and sell, build and sell. The vast majority build once, sell once. So are they an expert in selling? Yes or no?
No.
Are they an expert in building value?
No.
No, they're an expert in lifestyle, cash flow businesses. But they're incredibly bright, nimble people who, once you give them the data on what the game is, the first instinct is they look over and they say, this can't be true. Because if this was true, I would have learned it a long time ago.
How many business owners do you work with that all of the relationships are with them? So if something were to happen to that business owner, the value of that business goes down right away because no one else has the relationships with all those clients or suppliers or whoever it might be.
So if I walk down the hallway and I said, for the 9 attorneys that are in our firms, I end up being responsible for closing 70% of the revenue. Is that a good thing or a bad thing? It's a good thing for my ego, but it's a bad thing for the business, right? So at that point, somebody like Melissa, my friend, puts her arm around me and says, Joe, this is bad. And I say, no, but it's me. And she said, Joe, it's still bad. And then you build out.
Getting a discount.
So then you build out for other brands to cause that to no longer be true. Fair enough? Oops, I'm just going to pass by.
Well, no, on the personal financial, it's all the things that we've been talking about. Advanced estate planning, tax planning, insurance reviews, making sure that you're not overinsured or underinsured. I mean, a lot of business owners, they don't look at this, and a lot of times they don't have enough insurance.
Now, this stuff is probably not what their current financial advisor does. Is that fair? This stuff is somebody that plays in this area all the time. Now, if the entrepreneur, other than paying down real estate, is spending and isn't managing a lot of money, do they typically have a financial advisor that does this level of work? Now, I'll tell you, if it's a solo in a little office, they're probably not going to be able to handle this. If they're with a larger firm, they probably have a bench strength to get to this, or they need another. So we have to talk about augmenting, changing, or if we keep augmenting, I talked about, right? But that's a very frank discussion. Their CPA firm that got them there, will their CPA firm be able to take them through the sale?
Maybe not.
If it's the CPA firm they've had for 30 years, it's going to be a real small chance, right? Real small chance. My favorite comment today on the phone, well, he's really old and he moves kind of slow. So did that conjure up in my mind that the rushing through the sale together?
No.
No, and he might be the best thing in the world.
No.
What happens when I get old and slow? That's why you're making me box every week.
No, that's just for fun.
But you've got to be able to face head on, especially if you found this relationship through somebody, talking with them and saying, they're going to need more than you normally do. Who are you going to bring on your team to do it? Now, I know that if they're a financial advisor that didn't have this, could bring on some of that talent either by partnering with a great CPA firm, partnering with a great law firm. If they worked at a bank or a wirehouse, a larger firm, maybe even a larger BD, they might have back office support. But you're going to need them to tell you, yes, I'm able to do it. Here's the team. And talk to them and meet them to make sure. Because if this stuff doesn't get done, that number net isn't enough.
So, and remember
so the deal
also,
will get stalled unless you can do this stuff.
And remember also that when you're working with business owners, there are two paths that you're going down at the same time. You're going down the business path where you're making the improvements in the business, but at the same time, there are the advisors that are working on the personal and the financial improvements at the same time. So, whereas we say that there's 3 to 5 initiatives that are going on every 90 days, there's actually 6 to 12 that are going on, or 6 to 10 that are going on, because you've got the business initiatives, and then you've got the personal and financial.
So whatever profession it is that's with them, more than likely there's somebody in that profession, so let's say attorneys. We end up partnering with their current lawyers often, where their current lawyer stays part of the deal, and actually gets them at the end too, where we work it together, where that person gets paid as much or more than they normally would, but the client gets the long-term knowledge that the current advisor has, along with some of the techniques that somebody that does this all the time. You get in trouble when you're bringing somebody on board who doesn't do this often, who's trying to do it by themselves. Because then the terrible thing of no deal happens. It's not good for the client. Now, if the client doesn't want the deal, I'm great. But if they're not getting it because the advisor says, you know, Melissa, I've been thinking about it. This is kind of risky. Now, if it's really risky and we need to decide with Melissa, the business owner, what it is, I'm thrilled with that. But if we're saying that because I'm afraid to do it, or I'm going to lose the business, then that's not right. So often it's about bringing the right talent in as well. I'm not saying to supplant anybody, but to partner.
So
I'll go back.
So once you've been doing these initiatives for a while, you're not focusing on de-risking anymore. Now you're focusing on improving the financials and the operations, but you're going to get to a point where you're actually, you can start to harvest and you can start to manage your business. So this is where you can start to look at new industries, new products that you might want to take to market. Now this is where you have really started to see the improvement in the business. You've started to see an increase in your cash flow. And now you can make decisions on maybe you want to take some chips off the table. So maybe you want to go to a private equity or you want to find an investor to come in and take a small portion off, but you're not ready to sell it outright. So this is where there are things that opportunities are going to open up to you as you're going through this process, because your business has just elevated itself just by going through this process.
Most business owners get concerned about this because of an energy level issue. What you just said, Melissa, sounds like it will suck my life away. What if it didn't have to suck your life away, but it was partnering with other companies, bringing on the right talent, etc.? Maybe there's so much more cash flow, now you can afford the person that can make that part of the industry go well. It's these other things that, oddly enough, will increase its cash flow and make it worth more longer term.
The other thing to that is, at this point in time, your intangible asset value in the business is going to be increasing as well. And that is where, in today's world, probably 80 to 90% of value in companies today is in the intangible assets. It's not in the fixed assets and tangible assets anymore. So these are things where your human capital, your customer list, the software or the proprietary processes that you've put in place, the trademarks, patents, that's where all of these things become incredibly valuable. And that's what we're trying to elevate.
So recognizing that gets this number bigger. Working on it gets it a lot bigger.
So that slide was about doing it again now, right? Another benchmark.
We will, but you're right. But we're trying to say
there
this is
yet.
what we're hitting onto. So it's good business to do this, isn't it?
It's good business strategy. Every business should be. You shouldn't be building. When you build your business, you want to build it from a value perspective, not from an income perspective.
But what if I built it from an income for all these years? Can I build it for value now?
You can. You just have to start engaging in a process that's going to help you increase the value of your business. This is sound business strategy. Everybody should be doing it. And your business will grow.
So where most people start is that they're facing a decision. Do I keep and grow the business or do I transition it? In whole or in part, internal or external, and what does the implementation look like? I'd consider that when you get to that point, you really have to do these first three. If you do this without the first three, are you allowed to do that? Can you just sell without making it better? Yes or no? And what's the punishment for that?
That's money.
That's money. Now, if the couple that owned it for 30 years said, I'm okay with less money, is that okay?
Yeah.
My Aunt Sarah came to this country as a child bride of 15 years old. She met her husband once when she was 12 and for a week before she came from Italy. She built a life with him. He died early. She was a single woman running a grocery store and a meat market in the latter 20s, early 30s. Wore black her whole life. Built up, saved money, bought real estate. Back when women didn't do these things, right? So I tell the women of my family, you should honor her and not be upset with her for how grown she was in her older age. Look what she did. You're standing on her ability. In fact, where you're going to school is because what she was able to do for your parents that started all that. In her latter years, she didn't want to hear about no trust. She said, everything is in my name. And I said, but the trust is you. She said, no trust, my name. But you're going to pay more in tax. No, I'm not going to pay any tax. They're going to pay tax on what I got. I've given them all more than I started with. At the very end of her life, she died at 109 years old and 11 months. At 106, she conceded that she might get ill and not be able to take care of her own health care. And she heard there was a health care document. And she called the office here, and Peppino is little Joe in Italian. She called, and I'm her nephew, equal to her grandchildren in age. And she calls me, and she said she's now summoned me. Now, Anaheim from here is about an hour and 20 minutes. I made it an hour. Cancel the rest of my day. Because when your 107-year-old aunt, who sits at the head of the table for all family business, summons you, you come. She said, I heard about that thing. There's a piece of paper I can sign that's a health care so I can choose. Because last time I was sick, they wanted to say what to do with me, and I don't like their choices. I want it to be this person. I said, yes, Aunt Sarah. I said, that's part of, and I explained the rest. She said, no. Everything stays in my name. I just want that. I'd like to sign it tonight.
Right now.
So guess who drove back up to San Diego, talked to his team on the way, got the piece of paper and the Fruity Cream stuff, and drove back down. Was it her right to say that's the only document she had? There was a massive estate tax. Is that okay? Yes or no?
Yes.
It was her choice. It was her money. Did she understand her options? I've been talking to her about it for 30-ish years. She understood her options. She made a choice. Did she give away a lot of money during her life, way above her coupon amount? Of course she did, in cash. Did she give money to this one to buy a house and this one to this thing? Of course. But those were her choices. A business owner is allowed to get less for their business. This is work. I think the work pays well. I think the 1 year of work pays well. If you were to sit down with a business owner and say, Steve, I need you to work a little bit harder for the next 18 months. And at the end of that, the income in the business will more than pay all the experts that did. But at the end, if you sell, you'll get an extra $2.5 million. Is it worth it for 18 months? Now, this lady said no. But if she fully understands, is that okay? Now, she's going to do the work. Why is she going to do the work, by the way?
Because we're employees.
Because of the employees. It wasn't worth it for the extra money. It was worth it to make it stable for the employees. My value system would have said the $2.5 million and the employees. So we talked about what the steps are. When you get down to the deal, there's a lot that gets done. My gosh, we could talk for hours on what a transition looks like, what the deal looks like, how to create a slide deck for it, how to have a bidding war between strategic buyers and financial buyers. Who pays more, by the way, a strategic buyer or a financial buyer? Why does a strategic buyer pay more?
Some sort of economy of scale or benefit they can.
They're not doing it for the investment value. They're doing it for the leverage on the rest of their business. Fair enough? They're taking out a competitor. They're buying a process, a proprietary software, etc. That's pretty.
So what this is meant to talk to you about is, in the world right now, there's about 5 million baby boomers that own businesses. Of those, 3.75 million of them do not have a plan in place, don't have any sort of exit or transition plan in place. Of those, there's about 3 million that are going to attempt to take their business to market. Of those, 90% of them are going to be rejected. And the reason for that is because they're not ready for a sale. That means of that, there's only about 300,000 businesses that are going to be sold. So that's a huge percentage of businesses. Now, this is what's going on right now. We are just starting to see the amount, there's going to be a huge wave of business owners, because they're the baby boomers, that are going to start to put their businesses on the market. And this is what's coming in the next 10 to 12 years. Do you think there's an opportunity here?
The gentleman, I'm sorry, your name again, sir?
Kashif.
Kashif is in the business of helping business owners because he saw this wave. There have been many different ways. How many of you have been in your business line for more than 10 years? Have you seen the waves? You've seen the waves, right? Some of your friends ride that wave, my kids surf, ride that wave until their fin is stuck in the sand, right? And never look for another wave. Some of your friends ride the waves for as long as they are, and they notice a change and they go to ride a different wave. This is one of the other waves that's coming. It's coming because of what everybody's been talking about, the baby boomer thing. And I want to say this again. I'm a little pissed.
Oh, I'm sorry, I can't help you.
Somebody changed the baby boomer ages and what years are included, and now I'm included.
I'm not.
I know you're not. I used to be able to say those baby boomers, but 63, 1963 is now included in the number. Didn't used to be. So when you all noticed the change, you didn't tell me, and this is really terrible. So we baby boomers, God, that sounds terrible, are in the middle of this. Now, I will say, I think we're going to work longer than people thought. The business owners that we were on the phone with, that you said are in their 60s?
I want to say late 60s.
Late 60s. Most people would have said would have retired by now, and they're thinking about longer. I know a lot of business owners that are doing this longer.
70s. It's very typical for us to get phone calls for business owners who are in their 70s saying, okay, I know I should have started the planning 10 years ago, but here I am now. What are my options? What can I do? This is a very frequent conversation that we have.
However, there's another conversation here. The number of business owners in their young 40s that are built to exit. They're exiting within 5 to 7 years. They're building their business to exit. Yep. So there's a couple of things happening at the same time here.
So this next
and they're selling to strategic buyers. They're building for a strategic buyer.
Which is also why they're getting the value, because they're building it differently than baby boomers have. So this slide just is probably a very typical investment portfolio that you would see of individuals. But if we go to the next slide, this
Charlie
is what
says no.
a business owner looks like.
Yeah. Charlie, what are they in?
Half your pie has returned nothing for the last 8 years.
Right. Well, of the people that walk to you, Charlie, that have not been that have been to a standard financial advisor, do they walk up with something like this?
Probably 60-40,
60-40? What? Which one's 60, which one's 40?
Equity 60.
60 to 40.
I would agree with that.
But we're now in a market at right today, for those on the tape, at above 23,000. Are most people thinking that the equity is going to do real well in the next 2 years?
My biggest concern is that people have been lulled into a double-digit return environment that's not going to continue.
So something's going to happen. But that all being said, even if you made that 60 in blue and 40 in gray, business owners are different though, right?
Look at this slide.
There's an issue with that. This is, from a financial planning point of view, this sucks.
Okay, but here's the thing. Okay, so we had an exit planning event last week for business owners. And when we showed them this slide, they're like, okay. They were very, very comfortable. They were very comfortable with this slide. They don't view their business as a risk. It's very, very different. The way that they view it, they view the stock market as more of a risk than their own business.
If that was a real estate guy, it'd be all green.
Yeah, if it was real estate, all green. So let's just go, and it would probably be all one type of green. Commercial real estate, industrial centers, apartment complexes, etc. So often we'll sit down and talk with the business owner and say, I'm fine with this in your 30s, 40s, and maybe 50s, but somewhere down the line, I look at a spouse and say, this needs to change. And they say, because I know that this 80% of it, if you go through one of the 4 Ds, is going to be worth less than half overnight. And I know the cash flow is going to stop. So is it okay if we start to take some of the chips off the table? There's 7 or 8 ways to keep you in control and change this pie to something different. Now, do business owners like the word control or not?
If they're in control, they like it.
Agreed. Must be interesting in a relationship with you. But yes, if they're in control, they like it. So is there a way to stay in control and change this pie, yes or no? Yeah, there's ways to do this. There's ways to do this. And you know what? Everybody's going to do it a little differently. My dad, who died at 83 years old some 15 years ago, his pie was probably mostly real estate. Because every time he shoved money into the market, he did it, and 2 years later it was less than when it went in. And he knew people that jumped out of a building. So he had a bent. Was that fair? And he had a particular kind of real estate he liked. He said, you start to build your real estate value in residential, then you get serious and you go to commercial after that. And I'd prefer commercial and industrial, little things where little people pay, so you don't have a big tenant that can wipe you out. Is that fairly sound advice? I mean, if you're going to sit down with a 20-year-old person in the middle of college and you said, rich dad, poor dad, would that be good? It probably wouldn't shoot them up to be the high multiple sale thing, but it would keep them along the way. Business ownership is the same thing. If you build for cash flow, will you have a job? Yes. If you build for a strategic buyer, maybe, maybe not. If you build this thing for the wild return, you may have something worth nothing. So this is a financial planning conversation. If I could get the people from the business planning world and the business banking world to get real financial planners in the conversation, business owners would be far better off. Because this problem could have been solved years ago. The other part is, I cannot tell you the number of people that I sit with who don't know money makes money. Joe, why would I ever take my money and put it in that 2% return world where I could lose half? That is true, but it also can be the 20% return world. It can be the 5% loss world, but so can this. I look over and I say, so which year did you cut a check back into the business? Oh, that year sucked. I said, how much was it? About $1.2 million. So you're telling me the business needed $1.2 million, and you don't think it goes down sometimes? So it is valuable to get a great financial planner involved in the conversation to start talking about what it looks like afterwards. How does money make money? Now, I could give you a solid case that if somebody sold a business, they should invest in other businesses, invest in real estate, and invest in the market. I could give you a good solid case for that. True? I could give you just as a solid case. I've got a client who lives in Encinitas in a little 1,200 square foot house that has $20 million in bonds. He's in his 50s. Does he need to change that plan? Does he need to change the plan? Is he? But other than but does he need to change the plan for his lifestyle, for what he's doing? Will he have a fun life? Is he good?
He's good.
He's incredibly good. Who said that? He's good?
He's good.
I would argue that it doesn't make a lot of financial sense long term. But he said, look, I've done well by 3 ex-wives. I've done well by 3 children, 2 from one wife, 1 for the other. I'm done taking care of them all. This is what I got to do. I'm done. I don't need much. I surf every morning. I'm good. I travel first class to Europe about 2 weeks to 2 months a year. Other than that, I'm really happy. I'm wearing flip-flops. I go to Hawaii now and again, stay at a little surf ride or whatever. Is that a good choice? He sold one of these things. He said, Joe, I almost killed myself. I had all sorts of health problems. No more health problems. These are choices business owners get to make. They're not right or wrong. They're their choice. Are we as advisors willing to help them make that choice and know the variables?
Really quick, Joe. It's just a time check.
Okay. So transition, there's a lot that can be done. There's a lot where you can help the business owner look at other potential buyers. This particular one from today had a strategic buyer that called them. When we asked them, if this buyer doesn't buy, are you still willing to sell? What was their answer?
Yes.
Were you willing to sell a year before this? Never thought about it. But now their eyes are getting opened. If this buyer doesn't buy, do you want more money? What did they say? No, Kevin, come on, Kevin.
Their employees.
What did they want?
It's take care.
Happy employees. If this one doesn't buy, I want to make sure our employees are taken care of. If I tell them you can get half the chips off the table and make sure the employees are taken care of forever, get an annuity stream for the business and invest the rest, are they going to say yes?
Well, they kind of thought the ESOP was that.
They thought it was that. They found out it wasn't, right?
It was that, yes.
And they found out it wasn't. So you can kind of see ahead of time that they're going to be very open to taking half the chips off the table, staying in control of business, making sure the employees are taken care of, getting them vested in some of it over time, getting an annuity income stream out of the business, working a little bit less, and then investing the rest. Does that sound like a pretty cool plan? Which a year ago they weren't open to. In fact, today they're not yet, but you can see where they might. That's one of the ways to go. Do they have a financial advisor? No. Do they need a financial advisor? Charlie said, I'll go. Do they need a financial advisor? Sure they do. So this gives you some of the options that are out there. I will tell you, usually a business owner looks up and says, I'm sorry, those can't be the options because nobody told me. Or, like Melissa would say, someone has told them that they're all bad except for this one. So which person...
Or they don't even tell them that there are options. They just steer them towards the option that they want them to take.
So in the beginning of the presentation, I told you what Melissa does and grew up as, and I told you what I do and grew up as, right? I shared that with you. Why? It gives you my bent. It lets you know what I lean towards and why. So if I was a lawyer and only a lawyer, would I lean towards transactional fees, yes or no? If I was a CPA, would I lean towards the annuity stream of having the accounting done every year? If I was the banker that got paid for the transaction, would I be interested in the transaction? If I did ESOPs for a living, what would be the best plan?
ESOP.
There are some think tanks in universities that say they're experts on transition and analyzing transition, and every one of the clients that goes to them has an ESOP. I have no idea what you're talking about. But I think what it is, there are many more options, and then there's more than this. And you can customize for clients. It's a matter of partnering.
So here, we've just given you the pros and cons of each of these different types of options.
And these are available to you that we can download from Shelley as well. And the presentation is, so to family members, the pros and cons?
Management buyout.
shareholders and partners. Now, a great transition plan is to have somebody from each decade, 70s, 60s, 70s, 60s, 50s, 40s, and maybe somebody coming in their 30s that eventually go in. I know some great engineering and accounting, engineering and architecture firms that have done this. And as people retire out, they've got a pattern to go do this. So the firm stays alive. And the person that is coming in that's now in their 50s know that they've got an option to get out early, but if they stay, this is what it'll look like for income and what gets out later. It's a cool place to hang out, right? ESOPs, which can be incredibly powerful.
There are a lot of tax benefits to an ESOP.
Does everyone know what that is?
It's an employee stock ownership plan. It's where you are essentially selling shares. The owners are selling shares to an ESOP trust, which then is representative, and it is going to all of the employees in the company that are eligible. And so the employees in the company become owners of the company through this trust.
Having a team that's bought in, that feels the value, that feels ownership, whether it's actual ownership or not, is incredibly valuable. Customer service goes way up. When customer service goes up, everything gets better. You still need good, solid management. Now, I'll tell you, from my standpoint, I think ESOPs are a fabulous tool. But it's very important to sit down with the owners and describe what it looks like as you go through it, because it can feel pretty terrible.
Well, and ESOPs, they're very, very complex structures. They're regulated by ERISA, which is under the Department of Labor, as well as the IRS. And the Department of Labor comes in on a regular basis and audits these companies. They're also very, very expensive to implement as well as to maintain, because it's all compliance oriented, and you have to comply on an annual basis with the ERISA laws.
Now, the tax benefits really help. Yes.
What kind of filing are we talking about? Because I assume this has been around for longer than 10 years.
Oh, God, yes.
Regulation A and D and those kind of things weren't available until very recently as a structured option. So are we talking 504, 506? Is there like a specific exemption for this?
Yeah. So it's covered by a variety of specific exemptions. And there's a massive amount of case law behind it, too. So it gives us the interpretation, so I don't have the IRS running amok saying what it should be, versus we've got case law that tells us what it really is. There's a lot more safe harbor within this, and there's some people that do it outside of the safe harbor. I've got clients that are willing to take huge risks because they're willing to battle the IRS. I've got other clients that take no risk against the IRS. They get a bill from the IRS, and if it's under $5,000, they pay it. They just don't want to have the discussion because it doesn't pay well. By the time they pay their advisors to talk to them, it's more expensive. Charlie, you said so.
CPA community, valuation community loves ESOPs because every year you have to do valuation.
So Charlie said, for the tape, that every year these have to be evaluated, so the valuation community loves them because it's an annuity stream to pay on the CPA firms. Very true. It also is a social conversation. The company I've built, for the people that have been here a long time, should they vest in something like this? And because I can structure it for the people that have been there longer than less, that they people longer more, maybe that is that value. And for the people that have stuck with me past age 65 that vest all the way, it feels good to me. This couple that we talked about is a great example.
Then you've got your strategic and financial buyers. Very different types of buyers, by the way. Financial buyers are not looking to pay. They want to pay as little as possible for a company.
They're looking for a rate of return. Family office money came into this world.
Private equity's there too.
Yep, because they chase what feels good later. Now they left the equities world. For some reason, they said, "Let's go over here to this return on this type of investment." They were at apartments for a while. They were at office buildings for a while. They left this a long time ago. Because in this new economy, this thing's a dinosaur. I mean, we're having strategic planning conversations over the fact that we probably shouldn't have a brick and mortar office in 5 years. What does that look like? Scares the living hell out of me. Founders Group was built as a strictly virtual firm. Our law firms, should they go virtual? We went digital. 450 files got scanned, 350 of them at the last round, because we needed to go digital. Did it scare the hell out? I'm going to lose a partner over it. The one who walks around with a fountain pen. Somebody laugh. Different answers to keep control but get money chips off the table. Great to do. Kind of sucks.
But sometimes you have to. Sometimes the equipment, the assets are worth more than the business as a going concern.
So you said
have to look at it.
intangibles are driving the market. For companies that haven't worked on their intangibles, that have great tangibles, this is the way out.
Could be a way out.
Yeah. Do we offer transition services? Yes. Do we partner with great firms that do it? Yes. There are some firms that bring us their clients because they say, Joe or Melissa, we want to take this deal. We can't. These things need to be fixed. We're not in that. Can I give them to them fixed? But when they're done, bring them back to us so we do this. We have some engagements that are not in our backyard, but we can do virtually, where their strategic buyer needs to be local, and their local person that does this would be best. Whatever's good for the client. There's tons of good work. There's more good work than there is time. Remember that slide that showed you how many of these coming down the pike?
And then next steps. What does life look like after you've transitioned the business? What do you want to do? And it's about getting involved in that, whether it be charitable foundations or charities, philanthropy, travel, new ventures. You know, we were just talking about the sandbox that you set up so that business owners can go and take some money and just go play with it.
My lawyers, if we're in the middle of a transition or a transaction like this, look over at the client and say, can we take 10% or 15% of the sales price, put it in a vehicle where you don't pay taxes on it, use it as pre-tax money to do the next venture? How about if we structure something that's owned by your grandchildren that you control that will be building value in their lives? I'm sorry, say that again? And they get all energized. And as they come of age, some of them can work the business with you. Can we do that? They look over and they say, huh? I have clients that lean over and say to me, I don't believe in life insurance. And I say, life insurance isn't religion, it's math. You're allowed to give your family less. I'm cool with that. But you were required to understand you've decided to say no to math. There's a bucket of the stuff you're going to use in your life. There's a bucket of stuff you might lose in your life. And there's a bucket of stuff you're never going to use in your life. How much of that bucket goes to your family is all up to you. You're allowed to give up 40% of it, no problem. You're allowed to give 200% of that to them, no problem. But it's your choice. This is not religion, it's math. If you're working with us, you have to understand the math. You turned me down after the math, I'm in. So there are many ways to create these things, charitable or not, and value and not, and influence or not. It's about having an impact. If you talk to a business owner, absent exhaustion, do they feel like they've been impactful in people's lives, yes or no? An entrepreneur, do they feel impactful in people's lives? If you told them tomorrow they're no longer going to be impactful, would it be bothersome? Yeah. They need something else to do. I mentioned earlier on that I give everybody the book, especially boys in their 50s or 60s. I give them the book Younger Next Year. Anybody ever read it? Why do I give them the book? I give them the book so they realize their body doesn't have to decay and they don't have to do stupid things. That the impulse to be stupid doesn't have to be followed up on.
Was that book again?
Younger Next Year. It's written by a doctor that handles primarily men of their 50s and above, and a guy who went through that process about being healthier or not. Basic premise, our bodies start to decay at about 50 years old. You can trick your body to not do that by doing certain things. You have to consistently do it. Diet and exercise, look, you know exactly what to do. You're not supposed to eat French fries, duh. You know, it's fairly simple. And making stupid mistakes has ramifications.
There's a slide we didn't put up here that talks about, we have a whole bunch of statistics, and one of the statistics that we have talks about business owners 12 months after they've sold their business. This is in years past. Majority of them were not happy with the sale of their business and what they walked away with. And the reason for that is because they weren't able to do the planning. No one did the planning with them so that they could really maximize what they were able to do with their money. So a lot of the things that they were doing after they sold and in the next phase, they were doing with after-tax dollars because they'd already paid taxes on it. So, this planning that we do ahead of the transaction allows these business owners to feel a lot better after the transaction occurs because they're able to do a lot more with pre-tax dollars than what they did
That
before.
37% that goes to government agencies is voluntary. The 37% that goes to government agencies is voluntary. The family can decide to keep some of it, all of it, use some for charity, use some for other business ventures. But you can voluntarily give up 37%, which I'm cool with. I'm completely cool with giving the IRS 37%. If you know the math and the logic and you choose that, I'm in. But you have to understand the math and the logic. So you've seen our process for dealing with this. We talked about things to consider when you're working with business owners, things that all of us for the different professions need to look at. You've seen the trend of what's about to happen in the businesses that are being considered for sale or not. The 4 Ds that we talked about, where the value could be half or 1/4 of it.
Or go away completely.
Or go away completely, and it doesn't have to be that way. The difference between a lifestyle business and a business that's built for value. The good business sense that it is to build a value business because it increases cash flow and also increases value. The roles that hopefully each one of you saw that you play in this. The sage wisdom, the guidance, whether you want to be with them all the way through or at the end or both, whether you want to go in and give guidance for one particular part of the transaction or not. You probably heard a lot from us about choosing collaborative teams, people who are best in class that you can work with, that help you do what you do with that client. How sometimes it's not about what you need in being invested in a particular thing that happens, but instead in being involved in the moment. Oddly enough, great relationship advice. If you walk up to, if there's somebody you love and you walk up to a conversation very invested in an outcome, it doesn't tend to go as well as if you're involved in the conversation. That same advice works with business owners and your clients. That there be some sort of logic to sitting down with a business owner and the team and saying, here are the steps. We can go right to this and do this or that, but you'll have less. Or you can do this and you'll have more. And you can be involved. Here are the secrets of the industry and how you can affect that. Remember the person you're sitting in front of. How much do they have invested in a particular result, or are they involved in what you're doing and that result is okay with them but doesn't have to happen? Remember that a lot of people that should be at the table are not because the entrepreneur hasn't had those kind of people in their life. They've actually been warned to stay away from you.
We at the event that we had last week, there was a business owner that came to the event, and when anybody went up to her, she actually was sitting at our table. And when you walked up to her, she said, please, I have to make a phone call. I don't want to talk to you right now. She did not want anybody to talk to her because she had been warned that everyone was going to try and just bombard her. And so they're very secretive. They want to keep everything to themselves.
I get very concerned when I go to play golf. Now, I'm not good at golf, but I love to play. Most of my entrepreneur friends who have sold say, Joe, you can only play so much golf afterwards, so enjoy it now because you're going to play too much and hate it. Afterwards. I really get concerned when somebody gets in the golf cart or a foursome and looks over and says, hi, what do you do? Because what that means is they want to tell me what they do. That's usually not good for me because I've got 4 to 5 hours of this left. I'd much rather talk to somebody and get to know them and not have them say what they can do for me. I realize the lead in. I realize that's marketing. It's just not the marketing I like. I tend to work with people that I get referred into. When I had my heart problem, I didn't just go see any cardiologist. I talked to a bunch of doctors that I said, who's the guy? Now, my parents had it, so I had an idea. But it's the same for my dentist. It's the same for the person that fixes my car on down. Who's the person? I'm going to go over to Charlie and say, Charlie, I've had this Lexus for longer because I want to give it to my son. He took too long to take the friggin' test. I'm still driving this thing. The car that I want, it was supposed to come out in October. The new model isn't coming out until March. I'm thinking about thing that has a sticker and one's green and one's yellow and one's white. I don't understand that. I kind of want this. But this is important to me. Charlie, you deal with people that buy cars like I do all the time. Help me understand that.
Save your money.
Save your money, don't buy the car. But how many, like my wife would say, honey, if that's your only vanity buy, I'm good. $100,000 for that. You don't do the rest of these things. You rent it younger next year, we're good. It's a very simple conversation. There's not a lot of complication to it. Yes, is this stuff in there? Uh-huh. But it's a simple conversation. Fairly simple and direct steps. What do people get at the end of that? Increase that, and that. If that's what somebody wants, there's a way to get there. If they don't want that, the gal, if they don't want it, can they sell it now for less? Yes or no?
Yep.
We would contend as long as they understand the math and the logic. Was my Aunt Sarah able to have no estate plan and die with lots of money? Yes or no? Was that her right? Did it bother me? I got none of the money. Did it still bother me? But it was her right. It was what she was able to do. But she had the right to know. Most business owners, when they realize all this, look over and say, I'm not willing to give up 37% for the hell of it, Joe. I'm not willing to take out my employees. I loved them and trusted them. I'm not willing to let my business die. So with all that, did you learn something you didn't know before you walked in? We're around for questions. Thank you very much for giving us your time today.